indeed. What I would like to talk about today, and first of all, thanks very much for this invitation to this event. I think it's an excellent chance to discuss between industry, consumers, supervisors. What I'd like to talk about indeed is why good regulation is important to consumers. And I stress the word good over regulation. So I want to talk a bit about the role of insurers for customers, for businesses, and for the economy. I want to talk about why good regulation is vital, but also help to understand why bad regulation can actually be as damaging as too little regulation. I want to talk a bit about how regulation impacts insurance customers, and use some current examples to hopefully bring it a bit to life and to home in terms of some of the work we've been doing recently. And then I want to finish by talking about how we can collectively work together to achieve better regulation. So first of all, a quick introduction to Insurance Europe. We were actually founded in 1954, before the European Union was founded. In fact, we were founded to interact with the OECD. We have 27 members from the EU. We have 5 non-EU markets, including Switzerland, Iceland, Norway, Turkey, and Liechtenstein. There may be another one added to that at some point in the future, we'll see. And we have associate parties. So we represent well over 95% of the European market by premiums, so we cover life, non-life, reinsurers, mutuals, everyone effectively. Now our core role is to provide protection and help ensure people are protected and they have sufficient money in their retirement. And through that process, we pay out a lot of money to our customers. So, for example, for the latest year, we have information which I think is now 2015, 2016. We paid out nearly $1 trillion in total benefits and claims. Most of that was in life, and the rest split between non-life and health. So that's an awful lot of money coming into us through premiums and also going out to customers. But I hope you'll forgive me if I give a little bit of a sales pitch for all the other things we do, because I think as well as our core role, we do a number of other things and play other important roles for our customers, but also for society. And I'm going to mention these partly because I think what we believe is important is that regulation helps to nurture these other roles and doesn't limit them inappropriately. We do a lot of work in prevention, which often isn't so well known. We work with governments, customers, and other stakeholders. We help to reduce the risk and impact of natural disasters. We do a lot of work with governments, helping to make sure their planning rules try to avoid allowing buildings in flood-prone areas or build drainage systems to avoid the damage in the first place. We work a lot with road safety, car design, barriers, and also safe driving campaigns. Those who have been in Belgium or know Belgium, there's a famous campaign called Bob, which is organized by the Insurance Association there, which basically really encourage at every time you go out, someone should always be the Bob who will drive you home who doesn't drink. And so that's quite a famous campaign. So who's going to be Bob? And that especially is launched around celebration periods, Christmas time, it's especially active. But these sort of things, often people don't realize how much the insurance industry is behind these. And of course, encouraging less risky behavior so people don't have to claim in the first place. That includes a lot of work on smoke alarms, both standards and advertising, encouraging people, encouraging better driving behavior through no claims discounts, and also linking behavior with the premiums. And of course, education. In terms of business, because insurance exists, it helps business take place. By giving confidence to business people to make sure they can cope with certain events and keep running their businesses, and that helps the economy keep going and growth. We also, as our role as investors, and we're the largest institutional investor in Europe with nearly 10 trillion of assets under management, but we can help our customers gain access to a range of assets. Now, given I hasten to add illustrative because, of course, at the moment, some of those returns are a bit lower, but not all of them. At the moment, of course, the equity markets have been a very good place to put your money, especially over long term and in recent times. But if you take a long-term view, basically long-term illiquid assets often pay more than short-term, and almost always pay more than short-term liquid assets. Equities and property also are good investments. And it's important that people, especially for their pensions, have an access to all of these investments. And that is one of our roles. Now, sometimes it's almost treated as if it's something wrong to search for yields, especially in low interest rate periods. But we consider that one of our tasks. It's difficult for individuals to do all that. We have a duty to try to search for those yields, especially when rates are so low. And that's one reason why we've got much more active in things like infrastructure than maybe before. Now, as our roles investments, and it's a consequence of our business model and the nature of our liabilities, we take in significant premiums, and we can invest those premiums sometimes for many, many years, sometimes just a few months, but in long-term business it can be 20, 30, even longer in terms of years. And that's very important because that allows us to help fund the economy and be long-term, patient investors. It also allows us to be stable investors because of the nature of our liabilities and the fact that we tend to get premiums whatever the economy is doing. Our dependence on premiums isn't like the inflow for some other investors, which tend to dip very dramatically during crisis periods. For us, people still need to insure their houses. They tend to continue paying their pension contributions, and so therefore we tend to get a stable set of premiums to invest, and we don't have to act pro-cyclically in terms of selling at the wrong time. We can wait and see as long as we believe that most of the problems are market extravagance, either too high or too low, and we tend to wait and take a long-term view. And that's what we think is important. But now I want to talk about why good regulation is vital, but as I mentioned, bad regulation is as damaging as little regulation. Now, you'll see a picture of the Titanic here, so yes, we're going to talk a bit about the Titanic, and at dinner, someone else may be talking about Titanic later today, but in a completely different, fortunately, I was a bit worried he was going to use the same story, but it's a different story, and I think there's a number of different stories you can play around the Titanic, because obviously it was a terrible disaster, but I think it has some lessons for us as well in terms of regulation. But first of all, let's talk a little bit about good regulation. I think the good regulation is vital because prudential regulation, which is about ensuring the solvency of companies, is needed to ensure there's a very low risk of an insurer failing to meet its obligations to its customers. So that's absolutely vital. Conduct of business regulation ensures customers are well informed and protected from inappropriate practices. We have financial stability regulation, which ensures markets operate efficiently and minimize the risk of systemic risks and crises. And good European regulation can also ensure healthy competition and level playing fields, as well as helping to achieve efficiency. And obviously a lot of the regulation we're doing at European level is to try to ultimately gain efficiency, although I think we're not always successful in that matter, and we'll come back a bit to that later. But that's what regulation is there for, and it's needed. And the industry is not against regulation anyway. What we want is good regulation, and that's really what we want to talk about. So, on to the Titanic. Why can bad regulation be worse than too little? Well, first of all, there's one lesson from the Titanic, and that is, as you all know, it sank maybe you didn't know it was 1912, but it sank in 1912. Over 1,500 people died, and not enough lifeboats was one of the key causes of death. If there were more lifeboats and the people had been trained better to use them, then many more people could have survived. However, the ship was actually in compliance with all its regulation at the time. So obviously, if the regulation isn't well designed, it won't create the right outcome. At that time, they didn't believe a ship could sink so fast, and only some people would need lifeboats. The rest could be rescued from the ship. Obviously, they got that very wrong. This led, understandably, to a lifeboats for all movement, and new regulations came into force in March 1915, ensuring boats had many more lifeboats. So that seems very good. Many ships had to be retrofitted, so they had to add lifeboats to those boats, including a ship called the SS Eastland, a US passenger ship used on the Great Lakes. Unfortunately, that led to a disaster. The SS Eastland capsized just meters from the dock. and that happened in 1915, just after the new regulation had forced them to add new lifeboats. Nearly 850 people died. Too many lifeboats was the main reason. It made the ship top-heavy and prone to capsizing, and that was the key cause of death. Now, actually, during the discussion on the regulation, the shipping industry had warned that some vessels could turn turtle if you attempted to navigate them with this additional weight, but these concerns were not heeded. This SS Eastman actually had a history of stability problems, and they were known, and yet no tests were done to check what would happen if we added this extra weight at the top of the boat. So I think that really teaches us that regulation is obviously important, but it really is good regulation, and one has to be very careful about unintended consequences. Now, the consequences for insurance is never as dire as that, fortunately, but that doesn't mean the consequences are not important. And they can be significant in terms of consumers and more widely. So first of all, unnecessary costs can obviously lead to higher premiums or lower benefits. The information overload that was mentioned in the previous speech, or duplication, can actually confuse rather than help inform customers. Good or useful products could be withdrawn or have less availability because regulation unnecessarily restricts them. And also, it can lead, in terms of our investments, to potentially suboptimal strategies. It could lead to lower benefits, could be forcing us to shift from long-term, our traditional area, to short-term investing, which can impact the economy. It can also ultimately create pro-cyclical behavior, which can mean that instead of acting as a long-term stabilizers that we have in the past, can actually mean we join the pro-cyclical activity and start selling when everyone else sells, and adding to the financial crisis. And with 10 trillion of assets, the way we behave can make a big difference, both in normal times and in times of crisis. So the basic message is it's good regulation that matters. And sorry, one other point, it can unnecessarily constrain innovation and efficiency. So then I want to talk about some current examples. I think one example is disclosure regulation. And again, there's no argument that disclosure regulation is not important. And I think that we can also say that insurers in the past haven't always been the best at explaining our products in terms of complex language, in terms of sometimes not enough information about the details. But that doesn't mean that we should use that as a reason to allow bad regulation to come in. So we strongly support facilitating informed decisions by consumers. I think we have a strong view that it's quality over quantity that matters, that it should be simple, relevant, and meaningful. We should avoid information overload. We should avoid duplication. It should be digital friendly, which of course is becoming more and more important. It should be tested on consumers. And this is something we think doesn't happen enough. And in fact, testing generally doesn't happen enough. We'll talk about that a bit in Solvency II as well. We unfortunately didn't test that properly either. But as an example of the potentially excessive requirements that we're starting to see, and this is really often a function because at the moment the regulation tends to be done in silos with individual departments or people responsible for certain initiatives. And instead of really taking a holistic view and making sure they understand the whole picture, they tend to just add fulfilling their particular task, but not necessarily thinking about what does this really mean for the consumer. So someone trying to deliver PRIPS really should focus on what is the end outcome and not just on I have a duty to get this file done. So we see that overall that from 1994, where we had 20 disclosure sets of disclosure information, we see this accumulating up now to a situation where we have 119 different pieces of information. And obviously that, we think, is leading to overload, and customers can't really understand all that. And they tend to then, from a behavioral point of view, as was indicated by some of the studies, they tend to just reject all the information. And I think we've all done that when we get the incredibly long information about privacy information on the internet. We tend to just click, please get it out of my face, I just want to get onto my website. And we don't look at it at all. Whereas if, for example, it only indicated when it was storing personal information as opposed to general information, maybe then we'd read it, and if it was all on one page. Duplication also will confuse consumers, and at the moment we also see duplication across a number of different regulations. The IDD standard, IDD PRIPS chapter, the PRIPS regulation, and Solvency II directive. So these actually have overlapping requirements. And one of the things, for example, we pushed very heavy for in some of the regulation for them just to add one sentence, which is you must provide this information unless it's already provided by other regulation. But because that line was missed out, we're now in a situation where we have to produce the same information for Solvency II as in PRIPS or in MiFID, and yet we have to, and it's in different formats, but we cannot avoid producing it. So this now has to be fixed through more regulation or improving regulation, but we think a lot of it can be avoided in the first place by taking a joined up view and really thinking about what works for the customer. The other thing is we think it's really important for things to be consumer friendly and digital friendly. And here we have an example of something that Insurance Europe developed together with our members and in close cooperation with consumer testing in order to create something for non-life insurance. So this would be motor type products and house cover and travel and things like that. And this was specifically designed for insurance. And I think we'd contrast that with the PRIPS kit, for example, which has a very ambitious aim of trying to cover all products from all sectors that are related to certain investment type products. And while we understand the desire for that, the outcome is something which may not be actually so useful for the customer. So again, I think the idea that it's always nice to have a sort of a perfect holistic an approach which covers everything, but there is a risk that it covers nothing very well as a result. And I think that's the situation we're a little bit in with PRIPS. But if we look at the IPID, our IPID proposal, which, as I said, is we designed with very much the insurance product in line, but also just with some general principles. And there we can see, first of all, it's obvious that you can print. You can always have the option to print, but it's very friendly online. You can share with someone to get their views, or you can download. It has a layered approach, so you can have everything on one page and then basically go into more detail if you need it or want it, and how to do that can be made very clear and easy. It's designed for all types of formats, computers, iPads, even phones. And it's based on a friendly type Q&A, based on the types of questions people naturally will say about what do they want to know about this product. And obviously that takes some time and research to get right, but is really worth doing because you can boil it down to the key questions a consumer really wants to know and find a way of conveying that in a short, concise way, and then layering on more information if that's really needed. And we think that approach will tend to lead to good disclosure approach. And unfortunately for PRIPS, PRIPS is still better than what came before. If you look at how bad some of the previous requirements were, so PRIPS have made a step. But I think in trying to cover all products, we certainly find the insurance products have suffered in terms of the clarity of information and usefulness. On the IPID side, this is our proposal, and we are soon at the end of the process to see the proposals coming from EIOPA. But I must say, we have some optimism that a lot of the good ideas that are around, including some of those that we've put forward, will be taken on board. And I think the IPID, the document for motor and similar products, will be something really quite useful for consumers. So as I mentioned, some of the problems with PRIPS, it's actually a paper version. It's not designed for to be online. It's also quite long. It's meant to be 3 pages, but we estimate you can't manage to put all the information in less than 6 probably. It doesn't really work well on digital at all. And as I said, there's an overlap between Solvency II as well. So that's one example about disclosure. I would also now like to talk a bit about Solvency II. First of all, again, in terms of good regulation, we very strongly support Solvency II's objectives of a risk-based regulation. And the industry actually has been very active behind Solvency II right from the beginning and very supportive. And I have to also say, and Carol, if I don't say it, Carol will, Some of the problems we're having now, also I think the industry also missed, and in retrospect, we should have done more, encouraged more testing, and I'll talk a bit about that in a minute. But basically, what is it about Solvency II that makes it good regulation? Well, first of all, this is about prudential regulation, ensuring that companies are solvent and their risk of not fulfilling their promises is kept very low. I think, first of all, the fact that Solvency II has 3 pillars, recognizing that it's not all about money and capital, it's also very much about governance and risk management, the pillar 2, and also very much about strong and extensive disclosure requirements. It's those 3 things that if done well, and Solvency II does most of them certainly extensively, and a lot of it very well, it really can work. And that's one reason why I think Solvency II has the potential to be the gold standard for insurance regulation, obviously in Europe, but around the world. It covers a huge amounts of risks. It covers all the possible risks, and what's good about it, it doesn't even stop there. Just because it doesn't mention a risk, it absolutely makes clear that doesn't mean you mustn't manage and hold capital for that risk. The responsibility is clearly on the management and the board to make sure that they have understood their risks, and if the Solvency II standard formula doesn't cover a risk, that in no way means it's okay not to manage it. And I think that's a very important principle. In the past, regulation tend to be designed to say, well, as long as you comply, you're okay. So that, of course, meant that there could be some individuals who are literally following the letter rather than the spirit of the regulation. So good regulation makes it clear that if the principle behind the regulation as well as providing detail. Also, nothing is off balance sheet, which means you can't say, that risk I don't need to take because it's not included in my balance sheet. In the past, you may have heard the phrase off balance sheet, and at the moment, while the insurance industry, nothing's off balance sheet, one of the problems for governments is that some of their liabilities, including things like pension liabilities, are off balance sheet, which means they're often not noticed. A Solvency II makes sure that cannot happen for insurers. It also looks at group as well as solo requirements. It also has 2 levels of capital, a target, SCR, solvency capital requirement, and then a minimum. And again, this is really important because this allows for an early intervention process. It allows for a stronger and stronger dialogue and more requirements for the company to take action before you run out of capital and you have a real potential for failing your customers. This, I think, was a very important thing, which again exists informally and to some degree in different regions. But I think this idea that the supervisor has both the right but also the obligation to start interfering, one could say, if things aren't going right. And the SCR is set at a very high safe level. Even the MCR is actually quite a high level. And by the time you get to the MCR, that's when the supervisor can completely take over the company and decide what to do, absolutely stop new sales, take whatever action they need to do in order to make sure that the customers are their customer obligations can be fulfilled. It's also a very high level of protection, 1 in 200, which is already quite high, but of course in reality it's much higher because of the intervention means that even fewer cases will actually occur. And if you look at the number of failures of insurance companies, it is actually very low. And if you look at the number of cases, even where there were failures, the number of times that customers actually lost out, it's even lower. And I remember having an interesting, we had one presentation where someone was talking about Solvency II, and there was a Swedish insurance company person there, and he said, well, we agree Solvency II is a good idea, but in terms of whether it's really going to make a big difference in our market, I have to point out that there's never been an insurer failure in my lifetime, neither in my father's lifetime, and neither in my grandfather's lifetime. There's been it was over 100 and something years since the last insurance failure in Sweden. So while we fully support the need to move to a risk-based approach, we should be clear this wasn't done because there was a fundamental crisis of failures and the existing system just wasn't working. It was because the existing system, we were afraid it wouldn't work in the future and wasn't adapted to the world in which we were living now, being a 40-year-old system. So I think that's also worth remembering when we talk about Solvency II. We also have an internal model included because no standard formula can possibly work for every company. So Solvency II is a huge change and an improvement, but also a huge cost, and as we heard before, unfortunately that cost does eventually come back to the consumer. It's also, I think, generally too conservative, and that's what I think I'll talk about and how that can impact the consumer. But in terms of changes, and I won't go through all of these, but it is a huge change, and I think that in retrospect, maybe one of the lessons we learned, maybe we were a bit too ambitious. It's a real revolution rather than evolution, and I think if we were starting again, we'd probably divide it up into smaller stages rather than try for such a big bang. But basically, it changes almost every aspect of previous the Solvency I regulation, and it is a very big system. I think, for example, as we highlight here, in moving from this sort of very simplistic, non-risk sensitive system to a highly risk sensitive system, we have increased the number of the size of regulation enormously. We move from just under 200 pages to well over 3,000 pages, and that's a lot, especially for small companies to manage. So it's a huge cost. I think in the UK supervisors themselves estimate the cost was about 4 billion euros in the UK alone. So ultimately, as I said, that goes through to your prices on your insurance premiums. The costs especially are difficult for small companies, and so this is something we really believe it's important that the principle of proportionality is really applied in practice as well as in theory, and so smaller companies can cope with Solvency II. But it's also, it is very conservative, and so while of course having enough capital is really important, but having too much capital is also potentially damaging for consumers. And Solvency II is conservative for a number of reasons. First of all, there are layers of, I put hidden protection, because not many people understand how Solvency II works. It's a bit very technical and complicated for most people. And so therefore there are buffers that people don't even realize are there. And secondly, generally, unfortunately, Solvency II treats us as if we are traders when we invest and not as if we're long-term investors. And that really matters. It makes a huge difference in terms of the capital charges and the volatility. So if we try to understand sort of why is it conservative, especially for long-term business, well, if we start with asking ourselves how much money would we need to pay a liability, or let's say we had to pay a customer 1,000 euros in 15 years' time, how much would we have to set aside? Well, we can work that out by saying, well, if we held cash, or what happens if we held some bonds, let's say they're quite really high quality bonds, very low chance of failure, but still obviously some risk, how much would we need? Let's say we would need 800 euros or something. Then the question is, so that's what I would call a realistic cash flow approach, looking at what is the realistic expectation that we have to pay, 1,000 in 15 years' time, and what is the realistic return we can expect on a portfolio of bonds, high quality corporate bonds. If we project all that out, we can say, let's say it's 800. But Solvency II requires more than that, because it requires us to calculate the liabilities in a different way than that. Now there's reasons behind that, and I won't go into all the theory, but the idea is that we want to work out a transferable price for those liabilities. But that's different from the amount we need to actually pay the customer. And I think that's something that needs to be better understood and discussed, because that's where we may be adding too much buffers, which ultimately cost customer money or have unintended consequences. Then, of course, we have the capital requirements on top of that, which is, although we have to assume that we're investing all the assets risk-free, basically, we still have to hold capital for the fact that there could be some risk. And again, because we're treated like traders, in most cases, in some cases, that capital is excessive. Then, of course, the company has to hold a buffer on top. This is something the company decides, but the more volatile the whole system, the bigger buffer company will have to hold. So if the system is too volatile, unnecessarily so, then the buffers will be larger than they need to be. And then, of course, on top of that, the company may have some surplus. So the reasons why we think Solvency II is conservative is because the very large buffers are held because we think there's artificial volatility that needs to be dealt with. That in some cases the capital requirements are excessive because we're being treated like traders and we're not, and the risk for trading is much higher than the risk for long-term investment. And finally, because of these hidden layers that are within the liabilities. And I'll just mention some of those hidden layers because you may have heard of some of them, but we won't go into detail. One of them is the risk margin. One of them is we have to value the optionality in the liabilities. And finally, the fact that we have a risk-free assumption. We have to assume that all our assets are risk-free instead of recognizing the realistic yield. So those three reasons together can make quite a lot of difference. And that's something that we think needs to be better understood. And so that leads to quite a large amount of excess above what you really need from a cash flow point of view to pay the customer. But I just want to touch on why that matters to the consumer. So if we take two scenarios, one scenario is where we have the regulator taking care, and let's say that leads to the company having to hold 5% of the funds in capital. For a 10,000 euro investment product, that would be 500. If the shareholder requires a 10% return, which is something that many may do, then that means they want 50 euros back in order to give the 500 capital to allow that company to write that product. That means the company will have to charge that onto the customer. So that's 50 more in charges. That equates to 0.5% per year. If you take a second scenario where the regulator, let's say, is very conservative, doesn't really try so hard to get it right, says more capital must be better, so let's just be super safe. Let's say that leads to 1,500 capital needed. That would lead to 1.5%. Now, that 1% difference caused because of the capital is too excessive can make a big difference over the lifetime of the product. In the case of a pension product, that can reduce the pension pot by up to 20%. So there we can see a direct relation between if the capital is excessive, unnecessarily so, then the consumers ultimately will suffer. But the impact of too high solvency can have other effects as well. It can increase your premiums. It can mean that we don't have as optimal investment strategy because we end up investing everything very low risk instead of what's right for the customer. And of course, it could lower the benefits, as we've just seen, or mean that the products are no longer available. And we're starting to see some products like annuity products being withdrawn from the market. Prudential in the UK has just stopped selling annuities altogether, and that is largely because of the Solvency II capital regime. Now, if the higher capital is really needed, then of course these consequences are completely normal and okay. What we have to ask ourselves, is it really needed? And there we think the consumers should be as interested in as we are in asking the question, have we got it right or is it excessive? So just to finish off with achieving better regulation, well, I think we've talked a bit about this. It should address customers' needs, real needs rather than perceived ones. It should measure real risks rather than theoretical ones. It should be as efficient as possible, avoiding unnecessary costs and not unnecessarily conservative. It should be tested on consumers, on past data, and on future scenarios. It should be as simple as possible, but as complex as necessary. So we shouldn't make it overly simplistic if that doesn't work. We should very much focus on identifying and assessing the unintended consequences and understanding the cumulative impact. So, but if we work together across consumers, industry, academics, politicians, policymakers, we can arrive at good regulation. But we should bear in mind that getting it done is not more important than getting it right, and that compromise may be important, but if that compromise means it doesn't work, we shouldn't feel happy that we've got to a decision through a compromise. It has to achieve its intended purpose. And I'll leave you with the slides. This is the work that we're working on now, that we think the consumers should be as interested as we are in getting the right outcome. Thank you.